Welcome to All Things Financial, where we help you retire once so that you can retire well. Today, we are talking about annuities. Are they good? Are they bad? What are the different types, and how could one potentially fit your overall retirement plan? Join us today to learn all the ABCs of annuities. Welcome to All Things Financial, where we help you retire once so you can retire well. Today, we're talking about annuities. One of the things I like about the word annuity is that when I say it, I always get a big expression from people. And it's either, man, my parent had one of those and I'm glad they did because it gave them guaranteed income their whole life till they were gone. Or people go, man, I would never give another dollar to an insurance company. And so the response is never in the middle. It's either all the way left, all the way right. So today we're going to talk about the different types of annuities, what they're for, if one fits your overall retirement plan, and the things that you should be aware of if you're considering one.
Yeah, and I think what also contributes to that a little bit, a lot of like big talking heads have said negative things about annuities. For instance, Fisher Investments used to run an ad why you should never have an annuity, meanwhile being one of the largest stakeholders in an annuity company.
Right, American Equity.
Yeah, and you also have Susie Orman, right? There's sections in her book where she talks about, hey, my advisor says get an annuity, and her response is get a new advisor. I feel like people associate annuities kind of like what you said. Some people have a positive experience. Some people look at annuities as a four-letter word. And I think that a lot of it comes down to not understanding the space that they occupy in your portfolio, and also because there's a lot of annuities that aren't that great, right?
Right. When people ask me, what do you think of annuities? The way that I'd explain it, it's kind of like if I'm a home builder and somebody says, hey, Trey, I need you to build this home for my wife and I, but really I need to know, like, what do you think of screwdrivers?
Right.
I'd be like, well, if we're going to build you a house, like there's a chance that we use a screwdriver. Now, if there's a better tool, then we'll use that tool. So we're agnostic when it comes to financial products, but really what we're looking for is not the tool that we use, but what tool gets the job done the best.
Yeah.
And so when I think of annuities, I think of four different types. So we've got a fixed annuity, which is basically like a CD. You can get a fixed annuity in a 3, 5, 7, or 10-year mark. And typically, if you start with premiums of $100,000 or more, they give you a better rate than if it's less than $100,000. What's nice about a fixed annuity is that money that you set aside, there's no surprise in the return. You're not going to wonder what you get. Basically, you're locking up that money for a period of time. Typically, the longer you lock it up, the higher return. The shorter, the less the return.
Yeah.
But if you've got money that you don't need today, but you want to make money on that money, then a fixed annuity can make sense.
Yeah. So if you want zero risk and maybe you're somebody who would normally choose something like a CD. Yeah. Well, it's like a CD, except you're not going to the bank or credit union. You're going to an insurance company. That stated rate of return, it's not going to change.
Right. The second type is what we'd call as a variable annuity. So variable annuities are the number one complaint in our industry. And the reason for that is typically people enter into this variable annuity contract and they're hearing from an advisor that there's little to no risk. They're hearing about guarantees. And what's interesting is in my 12 years in the business, almost everybody, if not everyone I've ever met, they've thought their fees were going to be around 1% a year. And oftentimes they average 2.5% to 4% a year. And so a variable annuity is an insurance company that offers an investment that's tied to the stock market. And your return on your investment is depending upon the funds that you're in. But a lot of times they have different riders. Income riders, whether it's single for you, whether it's joint, so it covers you and your spouse if you were to pass away. Some of the other riders that they have is a death benefit rider, meaning that there's almost like some life insurance attached to that variable annuity. And then one of the things that we look at is where and when does a variable annuity make sense? Now, we've seen some that have had good performance, but a lot of times what happens is the high fees of 2, 3, 4% end up really cutting into what people end up getting as far as a return on their investment. The other thing that we often see is, I read a statistic and I wish I had the source, but 85% of people that purchase an income annuity never actually turn on the guaranteed income. And so one of the things that we would say is a variable annuity, they're typically designed for somebody that wants to stay in the market, but they want some guarantees. Anything you want to add on variable annuities before we move on?
Not only are they the biggest complaint, it's the biggest source of confusion too, because like you said, people are sold a variable annuity and they think they're getting something safe. A lot of times it's like right after they retire. It's like, hey, you've been in the market for 40 years, but you've also been working. You can assume a level of risk. Now let's dial back the risk. Let's get you into this variable annuity. And instead of mutual funds and ETFs, you're purchasing sub accounts, which function like mutual funds and ETFs. They go up and they go down, and you don't have that level of safety. But then what you end up paying for, all those various riders that you mentioned. So you end up having mutual funds, what we refer to as mutual funds wrapped in life insurance. And sometimes you can't get out of the contract, and what you have is a death benefit. So it's like now you're paying for very expensive life insurance, and it doesn't function the way you hoped it would.
On the variable annuities, one of the things that we would say is if your goal is safety, the question that you have to ask is, am I buying something that's safe, or am I buying something that has an income, and will I need that income in retirement? 85% of people never end up turning it on. So now you're paying fees for a feature that you likely are not to use. So really important to understand.
Part of the reason why the income features are now becoming more usable, or people are actually using them, is because rates have increased. So whenever you see that the Federal Reserve is announcing rate increases, things like insurance products and annuities become much more competitive.
Right.
So whenever you're thinking of like, hey, my portfolio, I know I'm not supposed to take out more than 4% based on the 4% rule. Well, you know what? My insurance product may not be competitive with that because rates are low. But when insurance companies start paying out 6 or 7 or 8%, now that income feature also becomes much more usable.
Very helpful. So variable annuities typically sold by brokers, not fiduciaries.
Yes.
High commission,
You have to
high
have a
security
license. Yeah.
Without getting into the weeds, our recommendation is that you stay away from variable annuities. We've never sold one, never will. The third type is what we'd call as a SPIA. So why don't you tell everybody what a SPIA is?
So a SPIA is a single premium immediate annuity. Now, I would say that out of all the annuities, like we definitely don't push variable annuities. We also typically don't push SPIAs because you give up control. With a SPIA, this is somebody who needs the maximum amount of income possible. There are different income options you can choose, but you're trying to get the most out of the money that you have. And basically the example that I often give is, hey, you know what? I'm going to give an insurance company this amount of money, and in exchange, they're going to give me a paycheck immediately.
So let's give an example. So if you use an annuity where you have control of the asset, it's likely that you're going to get a 4 or 4.5% payout. So if you think of $100,000, that person's going to get an annual payout of $4,000 to $4,500. But if they choose a SPIA, which means that you actually give up control of the 100,000, you're not going to get 4 to 4.5%. You might get 6.5 or 7%. So for the same $100,000, instead of getting $4,000 a year, you might get $7,000 a year. But the trade-off is that if you pass away, your spouse and your kids are not getting that payment. It's gone.
So you lose the ability to pull money for emergencies. You can't take money out for any other reason. That asset is totally outside of your control. You just have the paycheck. And in most cases, that paycheck ends when you pass away.
We've actually never sold a SPIA.
Yeah.
But there are cases for them. You know, if somebody's short on assets and they don't have kids or a legacy that matters, they just have to make sure they're going to be okay. That could be a fit.
If there's no other way to make up that income gap and they're just trying to get the most for their lifetime, and if that's all that matters, maybe. Yeah.
The fourth type of annuities are called fixed index annuities, which we tend to favor those. What we like about them is they're low fee and no fee. There's two reasons that we would use a fixed index annuity. We use them, number one, as a bond replacement. So if you think about the average retiree, the average person in and nearing retirement, they've got a 60-40 portfolios, or 60% equities, 40% bonds. When we look at bonds, historically, they've averaged a positive 3 to 6% return. How have bonds performed the last 5 years?
If you look at just the last 5 years, most bonds have posted negative returns in your portfolio over that stretch of time.
Yeah. So what's interesting is one of the things that we've done is for a handful, and I would say probably the majority of our clients, is we've said, hey, instead of having 40% of your safe money sitting in bonds, what if we diversified through a fixed index annuity, through T-bills, through money market? And it's one of the tools that we've used that actually lowers their fee, but also potentially gives higher returns. And if we look at the last, 5 years, a lot of them have had positive returns of a positive 2, 3, or 4%. So even at that positive 2%, instead of losing 2 to 3% a year, it's really a 4 to 5% swing, not including the fee. The second reason we'd use them is income. You want to talk about that?
Yeah. So I would say that as far as the income piece, they're not all created the same. So you really need to be careful. If somebody's pitching an annuity for income reasons, and you can jump in at any time, but there's going to be some income, fixed index annuity income products, some that have a separate value called the income value. And a lot of times that income value, they're going to attach a bonus to it, or it's going to look really, really attractive. And people think they're getting a guaranteed 7% or a 15% bonus, or sometimes even higher than that. be careful because that might just be on the income value, which is designed to calculate a paycheck for you, not the actual account value. So once you figure that out, the other thing is you need to figure out how that income value grows. Sometimes it grows by a guaranteed rate. Like, for instance, there's a company that we looked at the other day. They guaranteed that the income value would grow by 8.5%. And that sounds awesome. But you also have to figure out what the payout rate is.
Right.
So if it grows by 8.5%, but they're only willing to give you a 2% payout, while you have a nice, large, inflated income value, the money that you receive to pay for your groceries might not be that high. So always look at what they refer to as the roll-up rate on the income value, and then also the payout rate, which actually determines how many dollars you get off of that value. And I would say that they've come a long way. There's a lot of companies that are specifically designed for income only. And most people associate annuities with income. They're not all designed for income, but the income annuities today are much more competitive and the rates have gotten to be much higher.
Really good. I'm going to ask you another question. I'm interviewing you today. So one of the questions we get is, hey, I actually think that a fixed index annuity might fit my scenario based on the conversation that we're having. How do I fund that fixed index annuity? So we preferably fund fixed index annuities with retirement income from retirement accounts versus non-qualified assets. It's not always possible, but it's ideal. Why don't you share with everyone, if they're going to fund one, what type of money to use ideally and why?
We had somebody who recently came in and they inherited an annuity from mom and dad.
Mom passed away.
Mom passed away. So they inherited the annuity, and the annuity had a basis just like any after-tax investment would, and it also had a gain. Now, most of the time when your parent passes away and they give you an after-tax asset, you receive a step up in basis. In other words, nobody has to pay any taxes on that gain. Well, if you use after-tax dollars, like non-retirement dollars to fund the annuity, that entire gain is taxed at ordinary income rates for the person who's the beneficiary. That's a terrible trade-off, right, in most cases. The other thing is, if you fund an annuity with after-tax dollars and you end up using the annuity for yourself, for income or any other purposes, that gain is treated at ordinary income tax rates instead of what normally would be capital gains rates. So there's a lot of disadvantages in using after-tax dollars, which brings me to why we prefer retirement dollars.
Right.
And by the way, retirement dollars can be in multiple categories. We're not talking about Roth IRAs. We're simply looking at traditional IRAs or pre-tax dollars, which maybe initially started out as a 401k, a 403b, a TSP, TSA, 457, something like that, a retirement plan with your employer.
So ideally use pre-tax dollars, specifically because one of the things that we found is most financial advisors are what we call a generalist, meaning that they sell products, they sell investments, but they don't understand tax strategy. So what's important is not just that you have a good product. You need to make sure that you have the right dollars in that account so that when it comes time down to draw on that account, that you're minimizing your taxes, not increasing your taxes by using the wrong tool, which we see often.
And it's, really what it comes down to, and this isn't only true of annuities, it's true of any type of investment that you have. If you have an IRA and you have a Roth IRA and you have an after-tax account, the assets in those accounts matter. It isn't just that I have a 50-50 portfolio or a 60-40 portfolio, 60% stocks, 40% bonds. You have to locate the correct stocks, the correct bonds, and the correct tax classifications, because that actually matters too in terms of taxes.
Okay, how annuities work over time, accumulation versus distribution. So a lot of times if somebody purchases an income product, so let's say they take $250,000, they purchase a low fee or no fee annuity, and the purpose of that is to draw income. One of the things that we talk about when it comes to annuities is let it cook. When we talk about letting it cook, what does that mean?
So that's the roll-up rate that I was referring to. So a lot of, especially on the income side, they guarantee a roll-up rate where for the first 7 years or for the first 10 years, the income value is growing by 7, 8, 9, 10%.
Guaranteed.
But once you turn on the income, that roll-up rate no longer affects your annuity.
So one of the things that you have to understand is how many years does the roll-up rate continue? And how do you make sure that you draw on the benefit while you've given it time to cook or time to grow? But also not wait so long that you start at a later age that you're never going to get into the insurance company's pocket. Because one of the goals of the annuity is to really run down through your assets so that your account balance, hopefully in your late 80s or early 90s, hits zero, so that you can spend 3, 5, or 7 years where the insurance company is paying you every single month, even though you run out of funds.
And actually one of the nice things too, and we've been doing this long enough where we do have some clients that have been drawing on their annuities for 10 years at this point. And I had one person recently where the annuity balance is very, very low, right? But the income they're drawing from it is actually quite high.
Right.
And they're using that income to offset the required minimum distribution on their other accounts. So even if your annuity value drops to zero, the company may still be paying you 15 grand a year. You now don't have to take $15,000 from your other IRAs to satisfy that RMD.
Very
It's kind
good.
of a neat thing that can happen in some circumstances.
Yeah. So I would say, one of the other things that you have to look at is when you're talking with the financial advisor, are you talking with a team of fiduciaries where they have what I would call as a plan in mind and the tools that they use depending upon the goals? Or are you meeting with an advisor that's already decided which products they're going to sell you because they're product salesmen?
Yeah.
So one example of that is this week I met with a couple wonderful people. They're coming back in a few weeks. And they were sold a variable annuity. I was showing them that their fees were not just based off their cash value. Actually, their income rider, one of the fees was based off this fictitious income value.
Yeah.
So the fees were based off of a value that they don't even have access to. So what I was showing them is that the fees on their account that they've had since 2010, 16 years, have averaged close to 4%. What's interesting is their account, the cash value has only grown at 5% a year. So they had all the risk of the market. They only averaged a 5% return. The company averaged almost 4%. So almost as much as they did on somebody else's money. And then if they go to turn on this annuity, take income, here's what's crazy. The advisor that sold them the product, they set it up as single income, where if she passes, her husband does not get to participate in the benefits other than he gets whatever money is left. When we uncovered that on a phone call with their insurance company, you should have seen their expressions. And we got done and I said, I noticed that you were shocked by that. Were you guys married in 2010 when the advisor decided that this income was only for her? And she goes, yeah, we've been married for 3 years. So I said, did he offer an option to include him? And she goes, no, they didn't even bring that up. So I said, well, here's the crazy part. These big fees that you've been paying only cover your life. And she goes, it's actually worse than I thought. And I said, why is that? She said, I've beat cancer twice. So while I celebrate that I'm in good health and I've beat cancer, longevity for me doesn't look good. And now you're telling us with the insurance company on the phone that this isn't even designed to take care of my husband.
Yeah.
So the other thing is you need to understand the product that you purchased, hopefully before you buy it. But if you purchased any type of annuity and you've never had a second opinion, one of the things we can do is we can help you with that. So what I was showing this couple is not only did they not include her husband, who, by the way, is a couple years younger, which means he should have been included because he doesn't have his own pension. On top of that, this account was going to produce $36,000 a year of guaranteed income. Well, that sounds great, but here's the problem. They both have large Social Security benefits, and she has a pension. So I said, what's wild about this is that you were sold a product to give you guaranteed income in retirement, and here 16 years later, you guys have done so well with your money. You have no debt. You have low expenses. You actually have more income from Social Security and the pension than you need. So I said, if you're going to use this account that has high fees, you're going to be forced to pay taxes on an extra $3,000 a month or $36,000 a year that you don't need. So I said, what you guys need to do is move away from an income product because you don't have an income need. And I said, how do you guys feel about that? And she goes, I can see it. I don't want to pay taxes on money that I don't need, take it out of the market and put it in a savings account that isn't making anything.
Yeah.
So one of the things I would say when it comes to annuities is it's really important that you're not meeting with an annuity advisor. You need to be meeting with a team of fiduciaries that have you in mind that only recommend a low fee or no fee annuity if it fits your situation.
Exactly. Especially like on the income side, if there is no income gap, you're always going to be put in a position where you're introducing income that you didn't need, and now you have to pay taxes on that income. And it's not just paying taxes. You might be pushing yourself into a higher tax bracket.
Right.
You might be paying more taxes on your Social Security. You might not have the benefit of long-term capital gains rates being at zero. There's just like a cascading effect that can happen. And I think too, what's interesting that you pointed out, the fact that income was single income. Why is it that on all variable annuities, whenever we make the phone call with the client, we try to find out all the different fees, why don't they ever let you change it? Whereas on fixed index annuities, whenever you
You
go
have
to turn on
flexibility.
the income is where
Right.
you actually decide. And that's actually it's a small thing,
It's a big factor.
but when you actually go to make that decision, it's a huge factor.
Because the other thing is, not to be negative, but you don't know what your life's going to look like in 10, 15, 20 years.
Yeah.
You don't know if your spouse is going to be around in
Right.
10, 15, 20 years. The other thing that I see is a lot of times single income is chosen because the percentage for a single person is higher.
It illustrates.
So it just illustrates better, which is a sales tool. You don't want to be sold. You want someone that cares about you, that's doing what's best for you. The other thing that we often find out with a lot of these variable annuity companies is that to move from a single payout to a joint costs very little. Sometimes it doesn't even cost more.
Yeah.
Most of the time it's
Which
0.1%.
makes you think it just doesn't illustrate as good. On
Doesn't
the payout
illustrate
side.
as good. So the other big thing is we might confirm that variable annuity works in your favor and that yours performed well, and we celebrate that. We have a client that what's interesting is their cash value never grew, but the death benefit is 2.5 times the cash value.
Yeah.
So even though they have high fees, well, the account is worth $500,000, the death benefit's like $1.3 million.
And they didn't buy it for the death benefit.
No.
Like they didn't want.
But now they're stuck.
But they're stuck because there's no insurance company that wants to take on that risk.
Right.
Because if they get audited, it's like, hey, that's still a benefit you have. You're making me throw away this death benefit feature, even though you didn't want it. So they're stuck.
If you Google Hightower, which is another financial firm, and they've done a good job putting together a lot of illustrative videos, and plug in Hightower broker versus fiduciary. They've got a great video that explains the different types of options when you hire a financial advisor. One is commissions focused and product focused. The other is plan focused and fee-based focused. One of the things I would say to people is make sure you have an understanding of how your advisor is compensated. I think one of the things that good people do is good people or trustworthy people trust people.
Yeah.
And I think it's great to be a trustworthy person that trusts people, but you should always feel comfortable asking an advisor or an insurance agent, hey, you've recommended this investment or this product. How do you get paid on this advice if I move forward? If they are not comfortable explaining to you how they get paid, you should run for the door. I love talking about commissions. I love talking about fees because we do a great job of using low fee and no fee products so that we can help people do what's best for them, not what's best for us. And so if you've never asked that question, one of the things you should do is you should ask, how are you paid based on this recommendation? And what were the other 2 or 3 options and how did they compensate you? What would you add to that?
Well, so I 100% agree with that. The only thing I would say is, annuities have come a long way. I think for the most part, people sometimes, when we talk about people have a negative view of annuities, it's just because they don't understand them. Because when you look at whenever they talk about the golden era of retirement, they always talk about from the 1940s to the 1980s, when I think in the 80s, over 50% of the private sector had a pension.
Right.
Everybody had one. And it was so nice because retirement meant that you didn't have to worry about the ups and downs of the market. You didn't have to worry about funding it. You spent 40 years working for a company, and in exchange, they guaranteed
Peace of mind in
forever.
retirement. Yeah.
Yeah. But annuities, which are really, I would say,
They are pensions.
It's a DIY pension that gives you so much more flexibility.
Right.
Whereas with a pension, it's kind of like a SPIA, right? Where you have that benefit. Maybe, there's spousal continuation, but that ends once the two of you pass away.
Certainly.
Annuities kind of have that additional feature built in where you can actually have a death benefit. You don't have to use it for income. You can use it for accumulation. There's indexed annuities that cap the downside. But the other thing is, and I don't know that we have time to get into it fully, is the long-term care side.
Right.
Yeah, long-term care is a huge need that many of us have. A lot of states are actually, I think Medicaid is paying more than half of all long-term care needs for people. So it's a huge expense, and annuities have kind of come a long way in that area too.
So if you have a concern about long-term care, which everybody should at least visit the conversation.
Yeah.
There's 3 ways to cover yourself for long-term care. Number 1 is a traditional long-term care policy where you pay an insurance company just like you do for home and auto insurance. And in exchange, you're buying a policy that covers 25, 50, 75, or 100% of your care in your 70s is kind of what you plan for.
Yeah.
Some of them have an inflation rider on them. Some of them do not. If you are at a certain age, a lot of times it's too late to start that specifically because of the cost. The second type would be self-funding it. So you just decide, I'm not going to give money to an insurance company. where they actually help me with some of this. I'm going to manage the money on my own. I'm betting on the fact that I can do better and make enough that I can self-insure this. Some people have enough assets to do that. However, a lot don't, right? So then the third option is through annuities. And when we talk about long-term care through an annuity, what are some of those options that you see?
Yeah, so just to touch on this very quickly. So you're never going to get as much of a benefit typically from an annuity as you would with traditional long-term care.
Right.
But there are some benefits, like number one, underwriting. Underwriting is not a problem when it comes to annuities with long-term care features, typically. Now, some of them have a health questionnaire, some of them do underwriting, but the vast majority of annuities, when somebody says it's a long-term care annuity, unfortunately, it simply means that if you're drawing an income, they double the income or they triple the income. And that sounds awesome until you realize it's actually causing your cash value to go down twice or three times as fast. And once that
Well,
cash,
they spend your money first.
they spend your money first. And once your money's done, you just go back to the old amount that you used to receive before they doubled or tripled it.
Yep.
So some people look at that and say, I don't know how much of a long-term care feature it is, but maybe it is. But then there's actually annuities that take it a step further, and they call themselves long-term care annuities. And there's really two in the space that are very competitive. And one of them does do a health questionnaire. And the reason for that questionnaire is they want you to do it before you apply, and they tell you what your benefit will be before you apply. So assuming you give $100,000 to this long-term care annuity, they'll tell you before you apply whether they'll give you $200,000 or $300,000 to be used for long-term care needs or expenses that you might have. So you know right away whether your initial premium will be doubled or tripled. Also, the biggest thing is a lot of the best annuities, they'll base the triggering event on ADLs, 2 activities of daily living. So as long as you can't complete 2 activities of daily living, they're going to give you access to the long-term care benefit. Some of the other annuities, some of the ones that claim to be long-term care annuities are much more restrictive. They require you to be confined to a nursing home. Some of them are even more restrictive, and they say, hey, an assisted living facility won't count. A home health aide won't count. It actually has to be a very specific type of long-term care nursing home, right? So there's a lot of different things to be aware of. Without getting into all the details, we just want to make sure people know that annuities offer that third option when it comes to long-term care, not like traditional long-term care, not like life insurance hybrids, but a totally unique take on long-term care.
To wrap up on annuities, what we would say is there are 4 major types. One is get a basic understanding of each of them. Talk to a fiduciary if it fits your situation, specifically us. And come learn to see if it's a fit. Now, they're not a fit for everybody, but a lot of times what you have to decide is that you're not choosing a perfect investment or product. What you're choosing is, does this beat what I already have? Yeah. And so annuities are not replacements for stocks, but they are a good replacement for bonds and used as an income product if that's a need that you have. If you have any other questions, feel free to reach out to Yelisey or I at All Things Financial or atfwealth.com. And we'd love to help you with your retirement planning. Anything you want to say to end, Yelisey?
I think we hit it.
Good things ahead. Thanks for joining us on Annuities Today.
Advisory services are offered through CG Advisory Services, LLC, a registered investment advisor, and through Guardian Wealth Strategies, LLC, a registered investment advisor. CG Advisory Services, LLC, and Guardian Wealth Strategies, LLC, are separate and unaffiliated entities. The topics discussed on this podcast are for educational purposes only and are not intended to be investment advice or recommendations. Listeners should consult with their own financial professionals before making any investment decisions.